World is worried about what's happening to global markets, the dollar index strength as well, and the weakening economic cues coming in, particularly from China, but from some other parts as well. It's very important in such a point of time to take stock of what the charts are saying for relatively stronger markets and economies like India. And who better than to put all of that into perspective than Gautam Shah of Goldilocks Premium Research joins us on the show. Gautam, great having you. Thanks for taking the time out.
Good morning, Dave. Thanks for having me.
Gautam, I know that you, at various points of time, you look at the correlation between different markets and asset classes and try and determine what could be happening. Are you feeling the need to do that right now very much? And if so, what are the correlations telling you?
Well, Neeraj, I don't think there is much of a correlation because I think what's happened in the last 2.5 months is a very standalone kind of a rally for India. I think this is something that you also saw to a certain extent in patches in the 2003-2007 period when foreign liquidity took over. And now what you've seen in the last 3 months is that domestic liquidity has completely taken over. In fact, the fact that SIP money is now moving into the mid caps and small caps, I think is itself an indicator as to how things have changed dramatically in the last few months. And I just want to believe that India continues to be in a sweet spot. I think we had run a little ahead of ourselves. And given this correction, excuses are being put out from the global markets. But I don't think global markets really have a bearing because when I look at India and I compare it with the rest of the world, we track the MSCI indices. So if you actually look at India versus the world, India versus EM, India versus the developed world, we are still in a major uptrend. So I just want to believe that the overall trend is intact. I don't think global markets will play a very important role, whether it's Forex, whether it's commodities, or whether it's even the dollar index. I know it's rallied a bit in the last couple of weeks, but I don't think it's really going to have an impact. And despite the downgrade news that came from the US, if you actually look at the Dow and the S&P 500, they have held out well. It's really not triggered any major correction there. So I think what's gone through in the last 2 weeks is very normal. I think this is a great buying opportunity. There are no signs of topping out. And I think very soon you should have Indian markets get back on track and hopefully we scale that level of 20,000. However, as I've maintained my stand since the beginning of the year, this is not about the index because a 10% move on the index is these days close to 2,000 points. And we don't get that kind of visibility because there are just too many dynamic factors that keep hitting us from time to time. So this is a sector-specific, stock-specific, theme-specific market. If you are in the right themes, if you are more committed into the broader markets, you will do well over the medium term.
Such an important statement of fact and confession, if you will, that there are too many dynamic forces in a 2,000-point move on the Nifty, and therefore maybe it's difficult to gauge that. Gautam, thanks for putting that out. Just one quick question. I know you mentioned that global factors may not impact the markets that much. Still trying to understand before we get to some specific themes, because I heard you say that it's better to be in the right themes. But what are the charts of the dollar index telling you? Do you think it is headed higher?
See, I've been tracking the dollar index for a couple of decades, and I think what I've realized is that in patches, it has a great correlation, and then there are patches wherein there is just no correlation, even though we keep looking at the textbooks for correlation. I think we've come to that point in the last 2.5 months wherein liquidity has completely taken over, so some of these factors are just not important. Till a couple of weeks back, global markets were doing nothing. You look at Europe, look at Asia, look at US, and it was just the Indian market which was doing so well. Now, you want to attribute that to fundamentals? Well, yes, you can do that. But the big debate, once again, is really liquidity versus fundamentals. And as a chartist, I want to believe that liquidity is best understood using technical analysis. So coming back to the dollar index, yes, it's rallied to that level of 103. There is potential for a rally towards 105, 106. But does that mean that it's going to impact equities? I don't think so. There is a lot of talk around interest rates in India and around the world, whether enhanced interest rates could lead to money flowing out of equities and moving into debt. I think we are beyond that. And unless you see a major rise, I don't think money is moving out of equities anytime soon because at least the Indian investor has realized, the advantages of long-term investing. And I don't think that's running away anytime soon.
Okay, music to the ears. Let me start off with a subset of the markets, which is the bank Nifty, I know you mentioned that don't look at the index, look at pockets. I'm trying to think of banking as a pocket and asking you that relative to the Nifty as well, the bank Nifty has been rather sluggish. The HDFC Bank stock, Gautam, is testimony to the fact that the market is hands off, because you just don't see that moving despite all the promises pre-merger of what the merged entity could do fundamentally. What's happening here?
Whenever something becomes overanalyzed and a crowded trade, it generally takes a lot more time to come back in form. I think that's exactly what has happened to HDFC Bank, because there was so much talk around the stock doing well. Until a month back, it was actually trading at lifetime highs. But post this demerger, I think there's been a little bit of profit booking that has taken place. And, it's really become an elephant. So it's very difficult for this stock to run. It has such a big bearing on the Nifty and the Bank Nifty now. And because of that, I think the indices, the headline indices, have been under pressure. But coming to the Bank Nifty, I think the problem in the market in the last few weeks has been leadership, because banks have not done well. IT was in a difficult space, but then it's come back well and it's helped the market, sustain above support levels. Reliance has been at the upper end of the range. So because there was no leadership, what you notice is that the mid caps and small caps did very well all along. And the headline index, the Nifty, the Bank Nifty, and the NSE Next 50 did not do anything special, which is absolutely okay. Honestly, no complaints. We like that kind of a market because it is a stock pickers market. But I think the Bank Nifty is very critically placed around this 43,500, 44,000 zone. I want to believe that it will bottom out somewhere in this zone, turn around, and eventually go back to 47,500 to 48,000. So I would be bullish on Bank Nifty as a whole. And I think within the banking space, we love the PSU banking space. In fact, in the last 3 weeks, the PSU Bank Index is still hugging the 52-week highs. And I think it just has great potential to go up big. The smaller PSU banks have anyway done well. I think SBI, Canara Bank, BOB with great results. I think they'll all turn around. So if you have to play banking, rather play PSU banking for the next 3 to 6 months. The SDFCs, the ICICI banks of the world are typically Rahul Dravids in your portfolio. They'll not they'll not go down much, but they will keep ticking, for you from time to time.
Got it. Now, I want to get your views out from you. I've asked a few questions of my own. I've heard you say that thrice in this interview that it is good to be sector specific. You love these markets because it is a stock pickers market. What, to your mind, Gautam, are the strongest pockets in the market currently?
Well, I think there is frantic sector rotation and theme rotation that we've seen in the last 4-5 months. I think it's amazing how the market sees that rotation from time to time. It's almost like a 4 into 100-meter relay at the Olympics, wherein the baton is passed. When one, athlete is tired, it just moves on to the next athlete. And that's really what has happened in the last 3 months, which is great to see. In terms of leadership, I think we've all seen what pharma has done and the capability it has for the medium term. It was in a 2-year-long bear market. It's come back very strongly. I think it was under-owned. And now there is a lot more commitment. The smart money is very active there. And our working target for the pharma index is about 17,000. So there is easily 10-12% upside. The other sector that we really like from these levels is metals. So stocks like JSW Steel and JSPL have done well. We like the overall metals index setup. Unfortunately, the technicals and the fundamentals don't seem to be in sync, because fundamentally you cannot make a very strong case. But chartically, I do believe that metals could be the surprise winner over the next 3 to 6 months. So all the top stocks, right from JSW Steel to SAIL to Tata Steel, NALCO, we like all of them and we have been recommending them to our subscribers. And finally, I think the IT space. I think IT looks very interesting to me. I know there has been so much debate around it. There was a lot of negativity around it till a couple of weeks back. But the way some IT stocks have rebounded in the recent past gives me the conviction that bigger things are happening. And it's been in base building formation for about 6 to 9 months. So the potential is large. 31,400 is the immediate working target. Beyond that, we are looking at 33,500. And I think investing in stocks like TCS and Tech Mahindra and Wipro, you can't be losing money at these prices. Because at 19,600, 700 index, I think the risk management and potential downside in each of these sectors which I spoke about is very important. So pharma, IT, metals clearly top of the pack, along with banking, which I think could surprise from these levels.
PSU banks in particular, interesting. Today on Trade Setup, I spoke about the IT pack because of the kind of order wins that are coming through as well, Gautam. People were citing that weaker pockets of demand, and we're seeing large companies as well announce multi-million dollar deals, multi-billion dollar deals, if you will. So that is a good thing. Your answer on metals is interesting, because if that were to play out, you'll probably see China give some stimulus in some fashion. Fundamentally, I'm saying, let's see if that works. Now, a couple of questions on themes which have been the retail traders' favorite or the retail investors' favorite as well, Gautam. One of them is this whole PSU manufacturing theme, and railways is right up there, but a bunch of others too. And if everybody thought the moves are done, results came out and we saw a JWL or a erstwhile SEPCO move up. The others have kind of played to the fore. The auto ancillary companies which are getting railway orders are also doing well. Any thoughts on this if you've looked at them?
Yeah, I think railway is a little overdone, to be honest, to
Okay.
be looking fresh at these prices. See, at Goldilocks, we cover 81 custom indices. So indices that the exchanges do not provide, we like to pick them by making our own suite indices. And that's how we identified railway and, for that matter, even auto ancillary. It's done well for us. And for that matter, even defense. But I think at these prices, it's run ahead of itself. I think they are in fraught territory, if I may put it that way. But as a long-term investor, you want to stay invested, but definitely there is no case to be buying these stocks at these prices. But the other thing that we continue to like is defense. So in defense, again, you have about 6 or 7 stocks that could stand out really well. So defense can be bought even at these prices. But overall, you spoke about the overall PSU theme. It's coming back after almost a decade. And I've been such a big bull on the entire PSU basket for almost a year and a half. And the kind of breakout that I've seen on the charts, I think there is potential 20% upside on the PSE index easily from current levels, something which I do not have visibility for many other sectors in the market. So PSE, I think, as a theme will continue as an overall basket. It could be defense, railway, manufacturing, power, infrastructure. I think everything is looking pretty solid on the charts. And the beauty is, along with dividend, the dividend side of things, you have capital appreciation running hand in hand. So it's a wonderful place to be in on PSE, and I think it's a theme which your viewers should continue to look at and buy on every day. Like the current market environment.
Yeah, viewers, readers, all of them will benefit from this, Gautam, for sure. A follow-up question: you also probably devote some piece of advice to contrarian bets or dark horses which may not necessarily make the largest move in the next 1 week or 1 month, but are looking turnarounds or looking with something which has got very great potential. I'm presuming here, but I'm presuming it's a safe presumption. I would love to understand from you, Gautam, does anything fall in that kind of a bucket?
See, I think cement could be one, if you want to really call it a dark horse. See, I've been a big bull on the entire real estate space. I do believe we've discussed this last year also, that the real estate index broke out after almost a decade of consolidation. If you look at the 2007 prices and look at the prices today, many real estate stocks are far away from their highs, despite the big rally of the last 3 months. So it's about the context, it's about the perspective. Do you look at it from the recent lows, or do you want to look at it from the 2007 highs? So real estate, I think, is a big proxy that's going to play out over the next couple of years, I should say. And stocks like DLF, could potentially appreciate anywhere between 30 to 50%. So the point which I'm trying to make is real estate and real estate proxy, which is clearly cement out there, is a space which I feel could be a dark horse and can be committed into even at current levels. So pretty much all the stocks in the cement space, right from Ultratech, which has been our favorite, to Ramco, to India Cement, I think all look super solid on the charts, and I think can be committed into even at current levels. And real estate itself, this recent correction is such a great opportunity. A stock like DLF, I think, has corrected about 10% from the recent highs. So DLF, Oberoi, Brigade, Prestige, lovely chart setup from a medium-term, long-term perspective.
Got it. Gautam, now your basic thought is that by the way, so two questions roll into one. One is, at the start of this interview, and maybe I should have asked you this then, but nevertheless, you mentioned that this is a good correction which has come about, and very soon we'll be back on to winning ways. My question is it possible to maybe not predict, but at least hypothesize what could the levels be from where Indian markets could turn around, and what are the levels that people should keep in mind? Maybe they don't turn around exactly there, but slightly lower. That's fine. But two, more importantly, if the markets were to do as you are saying, are there pockets which will actually relatively be sluggish to this upcoming up move in Indian equity markets?
Well, Neeraj, it's my job to give out levels. It's my job to try and foresee the future. I think that's what we try to do based on technical analysis. And I want to believe that the market will try to bottom out at two numbers. So the first number is 19,300, which is where we are right now. And that's the number from where we have rebounded a couple of times in the last 2 weeks. So if this is a market which rebounds from 19,300, then everything gets back on track immediately. Immediately meaning in the next 3-4 trading sessions. If 19,300 does not survive, then possibly we go down to 18,900, which was the previous stop, and that's where the strongest supports are. So any which way, as a medium-term investor, you should not wait for the two numbers. You have to be a buyer right from current levels, which is around 19,300, and I don't see the market going anytime soon below 18,900. So these are the two numbers which we like, and if the turnaround happens, I think that the 4 or 5 pockets that I mentioned are the ones that should do well. The ones which we are not liking are the big winners of the last 3 months, which is FMCG, auto, and capital goods. They have been our favorites. ITC, we've discussed multiple times in the last 2 years during every interaction of ours. But I think ITC, we've let go of it. 10, 15 days back, we actually let go of it, and we added some other stocks in our G12. So the poster boys of the last 4 months is where we are not focusing right now.
Wow. Okay. And it's interesting, Gautam, that charts show this. I mean, FMCG is fine, understandable. Maybe fundamentally inflation worries come back, so on and so forth. But capital goods, everybody swears by that. And the commentary from the managements are so strong. You still believe that they will be sluggish relative to the market?
I'm talking about they being sluggish from a short-term perspective. Okay. Everything has its cycle. So capital goods had its wonderful cycle over the last 1 year. There is room for some consolidation stroke correction. It could be sideways in nature. It could be corrective in nature. And post that correction, we're looking at much greater upside. So if you ask a 2-year, 3-year, 5-year view, I think there is no way that you can avoid capital goods from your portfolio. But if you're looking at short-term gains, it's not the space to be in.
Yeah, no, I'm glad we got that clarification as well, Gautam, because a lot of people would view this as an indication even in the long-term portfolio. So I'm glad we got that clarification too. But thank you. This was lovely. I'm sure it's a breath of fresh air to bulls who've been worried over the last few days hearing all about the dollar index, the SPX and whatnot. So good to hear this view as well. Thanks for taking the time out, Gautam.
Pleasure, Neeraj, as always.
Yeah, the pleasure is ours. And viewers, thanks for tuning into this very important edition of The Talking Point.